XRP and the broader cryptocurrency market are often labeled as being in a bear market, but the reality is more nuanced than popular narratives suggest. Many analysts are quick to declare that prices will stagnate for a year or two, basing this conclusion on selective charts and interpretations of past trends. However, a closer look at the market reveals that these blanket statements often oversimplify what's happening. The notion of rigid bull and bear markets doesn't fully capture the complexity of the crypto space. Unlike traditional assumptions, downturns in the market are frequently asset-specific rather than universal. Certain cryptocurrencies may be declining while others experience notable gains due to unique catalysts. Early in the industry, market movements tended to affect nearly all tokens because trading behavior was less sophisticated. Back then, investors often treated cryptocurrencies as interchangeable, which is why concepts like altcoin season emerged. Large groups of lesser-known tokens would surge together, leading many to believe this pattern would persist indefinitely. In reality, markets are inherently unpredictable. Attempts to map cryptocurrency price action onto fixed cycles, like the 4-year Bitcoin halving narrative, often fail. Predictions about highs and lows or claims about bull and bear phases are frequently incorrect. The 2021 cycle is a prime example. Bitcoin and XRP were projected to reach unprecedented highs, yet those targets never materialized. Analysts simply rebranded their theses when prices didn't align, calling it a bear market instead of acknowledging that the original cycle assumptions were flawed. Examining the current cycle, gains over the past year have largely been concentrated in the top-tier cryptocurrencies. Many projects outside the top 10 have remained stagnant, highlighting that broad market movement isn't the main driver of asset appreciation. Despite claims of a bear market, this stagnation reflects a lack of catalysts rather than a structural downturn. XRP, for instance, is merely retesting previous highs, yet some interpret any temporary pullback as evidence of bearish conditions. The reality is that the value of individual tokens depends far more on specific catalysts than on arbitrary cycles. For XRP, developments like regulatory clarity, market infrastructure improvements, or large-scale institutional adoption would immediately influence prices regardless of market sentiment. Sentiment-driven volatility dominates short-term price action, but long-term growth stems from fundamental utility and adoption. XRP's steady progress in recognition and integration, including the emergence of multiple spot ETFs, sets it apart from other tokens and explains why top-tier cryptocurrencies have outperformed the broader market. Ultimately, predicting cryptocurrency prices based on past cycles is unreliable. Markets don't repeat exact patterns, and human behavior remains the central driver of all financial markets. What matters are tangible developments, growing legitimacy, and increasing demand for assets like XRP. Its real-world utility, ongoing institutional adoption, and steady accumulation of fundamental support make XRP a standout, demonstrating that long-term value is built on substance rather than speculative cycles or historical parallels. Many investors and analysts continue to rely on the familiar language of bull and bear markets, but this framework often fails to capture the true dynamics at play within the cryptocurrency ecosystem. The idea that markets follow predictable long-term cycles is appealing because it provides a sense of structure and certainty. Yet history shows that such structures rarely hold up under scrutiny. Crypto, unlike traditional markets, is driven by a complex mix of sentiment, technology, regulation, and individual catalysts. For that reason, labeling the entire industry as being in a bear market based solely on temporary price movements can create misleading expectations. What many people call a bear market is often nothing more than a period of consolidation, sector rotation, or asset-specific correction rather than a universal downturn. In the early days of cryptocurrencies, market cycles appeared more consistent because trading behavior was less sophisticated. When Bitcoin surged, most altcoins followed simply because investors treated them as interchangeable. This created the illusion of a reliable pattern, later reinforced by events like the 2018 altcoin boom. But as the market matured, investors learned to differentiate between projects with real potential and those lacking fundamentals. As a result, only certain assets experience growth during specific timeframes, while others stagnate or decline. This differentiation breaks the old assumption that the market moves as a single unit dictated by predictable cycles. Predictions based on four-year halving cycles or historical highs often ignore the evolving nature of crypto. Each cycle has been influenced by unique global conditions such as regulatory developments, institutional adoption, macroeconomic forces, and innovations within blockchain ecosystems. When analysts predicted massive price targets for Bitcoin and XRP in 2021, those projections largely relied on past cycle data rather than present fundamentals. And when those targets were missed, the narrative quickly shifted to claims of a bear market. Instead of acknowledging flawed assumptions, many simply adjusted their labeling to fit the outcome, which highlights the weakness of using rigid cycles as a predictive tool. Real market behavior is far more nuanced. Short-term sentiment can create rapid swings, but long-term growth stems from utility, adoption, and macro-level shifts. When people insist the market is in a bear phase, they sometimes overlook the fact that leading cryptocurrencies may simply be experiencing rotation or consolidation while still building fundamental strength. This disconnect between narrative and reality demonstrates why relying on cycle-based predictions can misguide investors. The market is shaped by human behavior, and humans are inherently unpredictable. Consequently, forecasts rooted in assumed repetition ignore the very nature of financial markets. Recognizing that labels like bull and bear oversimplify complex movements allows investors to make decisions based on substance rather than outdated assumptions. XRP's long-term value proposition stands on foundations that extend beyond speculative narratives or cyclical market assumptions, and this is what separates it from many other digital assets. Rather than depending on hopes that the broader market will follow a predictable pattern, XRP's strength is rooted in its utility and the growing institutional recognition it continues to receive. When investors look past short-term fluctuations and concentrate on what drives sustainable asset appreciation, XRP's position becomes clearer. Its purpose in cross-border payments, liquidity provisioning, and financial settlement gives it a functional role rather than one driven solely by hype. Real-world use cases create demand anchored in necessity, and necessity has always been a stronger driver of value than sentiment alone. Institutional interest further reinforces this point. The emergence of spot ETFs tied to XRP represents a major shift in legitimacy, signaling that large financial entities view the asset as more than a speculative token. ETFs open the door for traditional investors, sovereign entities, and regulated markets to enter the space with confidence. This form of acceptance doesn't just reflect credibility, it also lays the groundwork for higher levels of adoption and liquidity over time. When compared to thousands of other cryptocurrencies that lack clear roadmaps, institutional traction, or regulatory clarity, XRP's position is unique. Its integration into regulated financial structures gives it a durability that speculative tokens simply don't possess. In addition, the steady advancement in legal clarity surrounding XRP contributes to long-term confidence. Regulatory uncertainty has historically been one of the biggest barriers to institutional adoption, and XRP has already navigated challenges that many competitors still face. Each milestone in regulatory progress enhances the perception that XRP can operate within compliant frameworks, a crucial requirement for banks, payment providers, and government institutions. As clarity improves, adoption becomes less risky and demand more sustainable. Another key element is the expanding understanding among investors that value doesn't emerge from market cycles but from meaningful utility. As blockchain technology matures, investors increasingly differentiate between tokens with purpose and those existing solely as speculative instruments. XRP benefits from this shift because its use case is tangible and globally relevant. Even during periods of low market excitement, its utility remains, creating a potential foundation for continuous long-term accumulation. Market enthusiasm may ebb and flow, but infrastructure and adoption trends tend to grow over time. All of these factors support the idea that XRP's future appreciation is tied far more to fundamentals than to temporary cycles. As adoption grows, regulatory clarity strengthens, and institutional involvement deepens, the asset builds a trajectory shaped by real-world demand rather than arbitrary predictions. This positions XRP as a cryptocurrency whose value aligns with utility and legitimacy, creating a long-term outlook based on substance rather than speculation.